Assalamualaikum and a very good day to my respected beloved lecturers, Mr. MARIUS Benedict and my fellow classmates. For this group projects of the FAR560 for the programs of Bachelors and Accountancies, we've been assigned to do the analysis on the financial reporting standard code 141 for agriculture and biological asset. So this standard is applied on the account when it is related to the agriculture's activities. The accounts that will be impacted such as biological asset, the agriculture produced at the point of the harvest, and the government grant. So first of all, we have to distinguish the difference between the biological asset and the agriculture produce. So firstly, the terms of the biological asset is the livestock. The livestock or the living things for animals and plants. As for the agriculture produce, it is the products that being harvested by the entities of the biological asset. So we already choose two companies that are carrying the same natures of business, which are the Cakaran Corporations Berhad, that based in Malaysia, and the other one Olam, which is located in Singapore. So beforehand, let my friends tell you a bit about the asset of the companies for each of them.
Hi, I will be presenting recognition and measurement of Olam International Limited. First is property, plant and equipment. The cost of an item of property, plant and equipment is recognized as an asset if and only if it is probable that future economic benefits associated with the item will flow to the group and the cost of the item can be measured reliably. Subsequent to the recognition, all items of property, plant and equipment except for the freehold land are stated at cost less accumulated depreciation and accumulated impairment losses. Next is intangible assets, which is goodwill. Goodwill is initially measured at cost. Following initial recognition, goodwill is measured at cost less any accumulated impairment losses. Impairment is determined for goodwill by assessing the recoverable amount of each cash generating unit to which the goodwill relates. Where the recoverable amount of the cash generating unit is less than the carrying amount, and impairment loss is recognized to the profit and loss account. Other intangible assets. Intangible assets acquired separately are measured initially at cost. Following initial acquisition, intangible assets are measured at cost less any accumulated amortization and accumulated impairment losses. Next is financial assets. Financial assets are recognized when and only when the group becomes a party to the contractual provisions of the instruments. The group determines the classification of its financial assets at initial recognition. At initial recognition, the group measures of financial assets at its fair value plus, in the case of a financial asset not at fair value, through profit or loss, transaction costs that are directly attributable to the acquisition of the financial assets. Transaction costs of financial assets carried at fair value through profit or loss are expense in profit or loss. Debt instruments. Financial assets that are held for the collection of contractual cash flows, where those cash flows represent solely payments of principal and interest, are measured at amortized cost. Financial assets are measured at amortized cost using the effective interest method less impairment. Gains and losses are recognized in profit or loss when the assets are derecognized or impaired and through amortization process. Equity instruments. On initial recognition of an equity instruments that is not held for trading, the group may irrevocably elect to present subsequent changes in the fair value on OCI. Dividends from such investment are to be recognized in profit or loss when the group's right to receive payments is established. Impairment for trade receivable. The group recognizes a loss allowance based on lifetime expected credit losses at each reporting date. Impairment of losses are reflected in the allowance account of financial asset class on the balance sheet. Next is financial liabilities. Financial liabilities are recognized when and only when the group becomes a party to the contractual provisions of the financial instruments. The group determines the classification of its financial liabilities at initial recognition. All financial liabilities are recognized initially at fair value plus in the case of financial liabilities not at fair value through profit or loss directly attributable to transaction costs. After initial recognition, financial liabilities that are not carried at fair value through profit or loss are subsequently measured at amortized cost using the effective interest method. Gains and losses are recognized in profit or loss when the liabilities are derecognized and through the amortization process. Next is revenue. Revenue is recognized when the group satisfies a performance obligation by transferring a promised good or service to the customer, which is when the customer obtains control of the good or service. A performance obligation may be satisfied at a point in time or over time. The amount of revenue recognized is the amount allocated to the satisfied performance obligation. Revenue is measured based on the consideration to which the group expects to be entitled in exchange for transferring promised goods or services to a customer, excluding amounts collected on behalf of third parties. Thank you.
Hi, I will be presenting recognition and measurement of the company name CAB Cakaran Corporation Berhad, which is located in Malaysia. First is property, plant and equipment. Any revaluation increase arising on the revaluation of such land and buildings is recognized in other comprehensive income except to the extent that is reversed a revaluation decrease for the same asset previously recognized in profit or loss, in which case the increase is credited to profit or loss to the extent of the decrease previously explained. A decrease in the carrying amount arising on the revaluation of such land and buildings is recognized in profit or loss to the extent that is exceed the balance, if any, held in the property revaluation reserve relating to a previous revaluation of that asset. Property, plant and equipment is measured at the fair value at the debt revaluation less any subsequent accumulated depreciation and subsequent accumulated impairment loss. Next, intangible asset. Amortization is recognized on a straight line basis over the estimate useful life. The estimate useful life and amortization method are reviewed at the end of each reporting period, with the effect of any changes in estimate being accounted for on a prospective basis. Intangible asset acquired in a business combination and recognition with separately from goodwill are initially recognized at their fair value at the acquisition date. Intangible assets with finite useful life that are acquired separately are carried at cost less accumulated amortization and accumulated impairment loss. Intangible assets with indefinite useful life that are acquired separately are carried at cost less accumulated impairment loss. Next, financial assets. Financial assets are recognized when and only when the group becomes a party to the contractual provision of the instrument. The group determines the classification of its financial asset at initial recognition. At initial recognition, the group measures a financial asset as its fair value plus, in the case of a financial asset not a fair value, through profit or loss, transaction costs that are directly attributable to the acquisition of the financial asset. Transaction cost of financial asset carried a fair value through profit or loss are expensed in the profit or loss. Next, financial liabilities. Financial liabilities are classified at a fair value through profit or loss when the financial liability is either held for trading and it is designated as a fair value through profit or loss. A financial liability is classified as held for trading if it has been acquired principally for the purpose of repurchasing in the near term, or on initial recognition it is part of a portfolio of identified financial instruments that the group managed together and has a recent actual pattern of a short-term profit making, or it is derivative that it is not designed and effective as a hedging instrument. Financial liabilities of the group and the company, including borrowings, are classified as other financial liabilities. Other financial liabilities are initially measured at fair value net of transaction cost, and other financial liabilities are subsequently measured at amortized cost using the effective interest method, with interest expense recognized and on an effective yield basis. Revenue. Revenue is recognized when the amount of revenue can be measured reliably and it is probable that the economic benefits associated with the transaction will flow to the group. Revenue is measured at the fair value of the consideration received or receivable. Revenue is reduced for estimate customer return, rebates, and other similar allowance. Investment property are measured initially at its cost, including transaction cost, subsequent to initial recognition. Investment property are measured at fair value. Gain and loss arising from changes in the fair value of investment property are included in profit or loss in the period in which they are arise. equity instrument. An equity instrument in any contract that evidence as a residual interest in the asset of an entity after deducting all of its liabilities. Equity instrument issued by the group and by the companies are recognized as.
So let's move on to Olam as they treated the biological asset. So basically there's a 4 classes of the biological asset in the Olam company, which are the fruits on the tree, the livestock that mainly related to the dairy cattle, poultry that mainly related to breedings of chickens for meat and laying the egg, and lastly the annual crops. Basically each of these class has a difference of accounting treatments. As for the fruit on the tree, the fair value is estimated using the present value of the expected net cash flow, and for its almond, its fair value will be based on the market price at the point of the harvest. Secondly, the fair values of the livestock is determined based on the valuations by independent professionals, valuer, using the market price rangings of a similar age, breed and generic merit. And for the annual crop, it will be valued using the adjusted cost that will be based on the estimated of the yields and the cost of the crops of the harvest discounted for the remaining times of the harvest, that which approximately the fair value. Now let's talk about how Cakaran Corporation Berhad treated its biological assets. So basically the biological asset accounts in the statement of financial position is not being appeared or not being presented, since the directors of the groups and the companies anticipate that application of the MFRS 141 in the futures may have an impact on the amount of the reported and disclosures made in the financial statements. However, the company still do the notes to the accounts on the second account. So the only effects on the accounts on this for the biological asset is the inventory account, which falls under the MFRS 112. Where all the agriculture produce will be recognized as the inventories. I think that is from us. Thank you for watching, and any questions you may raise questions on the letter on comment below. Thank you.